Welcome back, everyone, to another video. Today, we're going to be talking about borrowing money from banks and lenders and the step-by-step guide that you as a business owner or a borrower are going to see throughout this process. So this video is dedicated to business owners and people that are looking to borrow commercial business loans from banks and private lenders. And ultimately, the questions that are going to be answered in this video are: where do I borrow this money from? What are the types of lenders that I can look at and work with? What is the lending process? And I'm going to provide you a quick summary of that process, the steps, the time it takes, things to focus in on, things to prepare for in advance to save time. I'll also comment on what affects a business's lending capacity. So what is a positive, what is a negative when you're looking at borrowing money from the bank, and how they'll look at those things from a lender's perspective. What are they looking for when qualifying a potential borrower in terms of you as the owner, your net worth, the business that is being lent to. And should you consider private lending sources? I know a lot of business owners sometimes will ask, what about private lenders? Are they a good source of money for me? Is that the best option? Should I go with the banks? And as well, are loan brokers worth it? Should I work with a loan broker in the business loan space to access funds? So, as a quick background, I myself came from the commercial banking world. So I worked up here in Canada for a large Canadian bank. I did about $220 million in term loan transactions, primarily for M&A, equipment, real estate lending. And so through my experience, I've really kind of systematized and kind of given you my teachings and my learnings on the job in the commercial banking world. So this is the perspective of a former lender that has lent to lower and mid-market companies in the Canadian marketplace, and it is fairly relevant for U.S. lenders as well. So what is the lending process? Well, on average, typically a term loan or submission where you're looking to access funds can range anywhere from 4 to 12 weeks, and it ultimately depends on the type of lender. Banks and larger banks are going to be a lot slower because there's a lot more bureaucracy and process, whereas a private lender, it may be their money that you're talking to. You may be talking to a private investor in your local community that gives out mortgages as an investment for their personal portfolio. Well, you're dealing with the decision maker, so it's going to be quicker, right? Also, the size of the loan is going to influence, the performance and the speed of the transaction. A $100,000 loan is going to get approved relatively fast relative to a $100 million loan. The type of loan, so is it a working capital loan? Is it a term loan? Is it an equipment loan? What type of loan are you looking to access? And how prepared and organized are you to handle the due diligence process? The steps that are here below. Like, are you prepared for this? Because ultimately, you can as well save some time in this process if you're prepared up front. And as well, the time of year. That is another one that impacts the lending process in terms of time, because if there's seasons where there's holidays, then some of the internal risk managers or banking officers that are going to require to sign off on the deal may be off on vacation, and therefore you may be penalized by that as well. There may be a busyness in the market. Typically in the spring and fall months, lenders are busier than in the summer and winter months. So if you're in the busier periods, maybe they're looking at a ton of deals and won't be able to underwrite and analyze your deal as quickly as in the slower months. And as well, there are certain situations you want to think as a business owner, when is the fiscal year end of the bank? So a lot of the banks in Canada, for example, their fiscal year end is October 31st. So if you're a new prospect coming in, in and around late October, those lenders are going to be so busy with their year end that they're not really going to give you a lot of attention for the first 2 weeks before and after the year end for that bank. So, it's obviously better to either show up before October or come after October and well into mid-November to deal with lenders. So there are various considerations that influence the timing of funding from initially meeting that lender to the ultimate funding. And those are typically the 5 areas that influence that timing. Now, in terms of the process, these are the steps that you're going to go through to access money when you're dealing with a lender. The first is the pre-deal. It's the initial meeting, the first 2-3 meetings that you meet with the lenders or lenders to get multiple different term sheets. And ultimately, in those due diligence stages, everything's fairly light. Lender's going to take you for your word in terms of, okay, I'm doing this. This is what my business is. This is what my business generates. Here are my financials, et cetera, et cetera. So we'll walk through what lenders typically look for in terms of information at this stage and what, you want to focus in on. Then there's the initial due diligence. So they'll take that information in those initial pre-deal introductory meetings, and they'll put together an internal file and due diligence file and a financial model to analyze and determine whether you can afford what you're asking for. If you're asking for $1 million, they're going to ask for your financials, any form of cash flow normalizations, and determine if you can borrow that $1 million relative to what the business generates and what you and your net worth can also offer. Because ultimately, lenders are not just looking at the cash flow that a business generates, but it also could be your personal net worth if you're personally guaranteeing that loan, or it could also be other assets that you're leveraging. Maybe you're putting up your house as collateral or putting up, an investment portfolio to lend against. So lenders will consider all of those things that are fleshed out in the pre-deal stages. So once they do that and they internally review the file and they're comfortable in supporting your transaction, they will issue a term sheet. And the term sheet is a non-binding document which communicates from the bank or the lender to the borrower what they're willing to offer. I'm willing to offer you X amount of dollars at a rate of X with terms of a Y. And so those term sheets, the borrower is going to receive and decide and negotiate and say, can you lower the rate? Can you give me a little bit more here? If I give you more of security or whatever the case is. So you negotiate the term sheet and ultimately you sign that term sheet. The moment that you sign the term sheet, then the lender is going to begin to do the credit underwrite. So this initial due diligence is a very preliminary, maybe 2 to 6 hours spent by a lender looking at your deal and thinking, is this something that can get approved by my risk team and that is doable? Because obviously lenders do not want to take on deals that they cannot get approved and funded because it's a waste of time. And the reality is bankers are salespeople. Bankers are looking to sell debt. So they want to deploy debt to businesses that can afford it and that obviously are going to get approved by the bank in terms of funding because they have to meet quotas and budgets in terms of funding $40 or $60 million in debt, right? So for myself, I had a $45 million debt transaction budget that I had to meet on an annual basis to really support that. So, there are certain, from a lender's point of view, they want you to borrow that money and they want you to make sure that you're borrowing enough for what you need and maybe a little bit more for their sales budget. So they're going to spend a lot of time pre-qualifying and making sure that this is a doable deal. But the actual underwrite, the analysis of the business, doing a site visit, touring the facility, understanding the competitors and the dynamics of your marketplace so that the bank can internally review and understand your business in more detail before giving you that money is going to happen at the credit underwrite stage after you sign the term sheet and commit to exclusively working with that one bank to get the deal approved. Now, once the underwrite is complete and this is prepared by the banker that you're talking to, they're going to take that internal file and submit it to the bank or lender's risk team. Now, the risk team are non-sales oriented. The risk team are essentially the defense to the offense. The bankers are going to go out and meet, accountants and meet business owners and try to source debt for the bank, but the risk team keeps them in check, reviews the credit underwrite, discusses internally, is this a deal that we're comfortable in funding? So they're kind of protecting the purse for the bank and being that second line of defense after all this analysis is prepared for by the banker that you're dealing with. Now, there are certain revisions that may happen. The risk manager may come in and say, hold on a second, we want more security if we're going to give this type of amount of money, or we would like to see more information in this area or a better understanding of the competitive situation and pricing and blah, 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 right? It could be anything and more specific to the business that's being analyzed. But ultimately, the risk team is going to approve and sign off on that credit underwrite and approve on the high-level terms that were discussed in the term sheet. And so the banker is going to offer you as the borrower a binding offer of finance. And so after the deal is approved, those terms or whatever terms that are signed off by risk, and things may change in the underwrite, whatever gets signed off on, that is put together into a legal binding document. And so that offer of finance or that financing commitment legal document is prepared by the bank's legal team, and you as the borrower will sign that. And the moment that you sign that, that is now a binding document that you've signed and you've committed to going through with this process. And so once the offer of finance is signed, or in some certain situations, I've actually seen situations where banks will actually wait for the offer of finance to be signed until the day of closing. But at the bank that I worked for, we actually got the client to sign up front so that they were fully committed to the deal and the terms, and then we would begin legal due diligence. But the bank is going to have a legal representative, a lawyer, that's going to draft up all the security agreement. If they're taking a security or registering a lien against your property, or they're registering a lien against your business, those are prepared and submitted and done by the bank's legal counsel. And that's all done after, the credit is approved and fees are being incurred, right? The bank is not going to start legals before the credit team signs off on the deal, because if the credit team doesn't sign off on the deal, then you're incurring fees for nothing. Once all of that legal work is done, the security is registered, you've signed the offer of finance, then the funds are ultimately dispersed and the loan is funded. And the reality is that's actually the start of your relationship with that bank. Then there are the post-close obligations that are on an ongoing basis. Certain annual reviews, credit reviews, items that a bank are going to require on a quarterly or annual basis to review. So you need to submit those documents on an ongoing basis. So these are the phases of the lending process. And again, I'll kind of delve down into each phase and give you more detail. It sounds like I've already given you a ton of detail 11 minutes into this video, but there's a lot more detail to be discussed here. So in terms of the process, just to give you, going back to the 4 to 12 weeks, typically the introductory meetings and up to the term sheet, it can really take, it's at most can take about 20% of the process. Like realistically, I would meet with a prospect on, a Monday. I'd ask for the information. They get it to me by Wednesday. I would look at it, and by Monday or Tuesday the next week, so 5 days overall, I would have a term sheet in their hand. So it's relatively short to get the term sheet. It's relatively quick. Where a lot of time is taken is afterwards. The credit underwrite and the back and forth with my internal risk team could take a very long time. It could take weeks. And ultimately, you as the borrower, you want to make sure that you have this information ready to supply the banker with, so that they can complete their underwrite quick and they can go to risk and do the dance that internally happens when you're looking to approve a loan. And then ultimately, the back end is also can be time delayed when it comes to the transactions and the legals. So again, if you're registering liens and security against certain assets, you want to have the legal documentation prepared, the deed and the title of trust, and certain trust documents and incorporation documents that are relevant for that bank to register a lien against your business. So you want to be organized, and usually some people aren't, and so a lot of this time is just wasted waiting on the borrower to organize themselves and get sorted out. So, the initial stages are fairly quick and rapid. Where a lot of time is taken is in the next two phases here. You can't really control the second phase as much as you'd like. Unfortunately, some banks are just super bureaucratic and are slow in terms of approval. But the last phase, I think this phase you can control the most as a borrower. You can push your legal counsel to move that transaction paperwork back and forth between the lawyers to speed things along. And as well, you can focus on getting your legal documentation and registrations in line up front to avoid the back and forth that will happen in terms of the bank waiting on you to get your ducks in line. So that's kind of the lending process overall. So I'll kind of take a step back first. The reality is, when I talk to clients now, I'm in the M&A world, but I still help clients with their financing. And the reality is, some clients are so frustrated with the banks and with a lot of these larger institutions, the national banks that are publicly traded. They're really frustrated with them because they're not getting the right level of service or attention or turnaround time. And what's really funny is that a lot of the time you may actually find yourself in the wrong group. So it's important to understand where to borrow from so that you get the proper level of attention, service, and resources dedicated to you. And this typically happens with lower mid-market businesses. You were a small business before with that bank, and now you've grown for 10, 15 years, and all of a sudden you're still dealing with the same account manager at the branch level, but you can actually graduate to the next level. So it's important to understand the levels within the bank. There's the branch level. You walk in, you can get your $100,000 operating line or maybe some Visa credit cards. But, to borrow any significant sum of money, the branch is not the place to deal with. You want to go to the more dedicated divisions within the bank that are dealing with larger amounts. So typically the divisions are small business banking for up to $1 million in exposure or $1.25 million in exposure. And then there's lower mid-market and mid-market banking. So a lot of clients that I see, they typically deal with the branch and they actually need to deal with the mid-market team because they're now at that size. So, be cognizant of when you're dealing with your lender for a long time, you may have actually graduated beyond the person that you're dealing with. And you need to deal with the right person to get the deal done correctly and fast. So in this situation, on the left-hand side here, you'll see the values of the loan exposure or the lending amount that these groups will handle. So if you're sub $1 million, you're going to deal with a small business bank. But if you're borrowing a $7 million mortgage for a commercial property, you're a lower mid-market or mid-market team. These kind of intermix. Sometimes they're a singular group. In this example, I've kind of split the two. But in this example, you'd be dealing with a lower mid-market team. So when you're dealing with a bank representative, you want to always ask the simple question, what is your target lending range? Are you focused on lower mid-market companies, or should I be dealing with another division within the bank? And make sure to get referred to the right division so that you're working with the right people. Because ultimately, the irony is these small business, lenders are going to think very differently about your deal than the mid-market guys. And in most instances, small business or branch level bankers don't have the products that you need. Maybe you need an interest-only mortgage, or you need some form of a revolving facility, and they only know how to underwrite operating loans. There's a big difference in expertise and products range. So deal with the right division. Now, where do you borrow from in terms of the industry, the type of lender? Okay, so I talked about the internal divisions that you should be dealing with when you're looking at dealing with a specific lender, but what lender do you want to deal with? Okay, so I kind of put it on this scale, and I really like this because it simplifies the discussion. On the bottom axis over here, you have the cost of money. On the left-hand side, very low cost, and on the right-hand side, higher cost. And as well, the willingness to take risk, the risk appetite of the lender to deal with, higher risk businesses or higher leverage amounts. And when you kind of put it on this axis and this axis, you can really segment the market into 4 buckets. You have the banks and the Schedule A lenders, the JP Morgans and TDs and RBCs of the world. And, they're big, powerful banks. They don't want to deal with high-risk companies that, are barely generating cash flow. They have their pick of the litter. They want to deal with AAA clients, double A clients. So, they're not going to go after the Bs and Cs of the world. Or if they do, they're not going to be as competitive. Whereas obviously on the opposite end of here in the top right, you have private lenders. Private lenders are not going after the bank's potential prospects. They're focused on high growth or high risk companies that are willing to borrow at those rates, right? Banks are going to be the cheapest, whereas private lenders are going to be a lot more expensive because they're going to price in the risk of that potential borrower. Now, on the bottom right here, you'll have credit unions. And credit unions are interesting because they kind of play in between. They're not really AAA lenders that are going after the perfect clients. They want to focus on local community businesses and have a specific mandate to lend to those businesses. But those businesses may be too small for the big banks. And so therefore, there's more risk associated with the target market of credit unions. So they're in between, but they're obviously not taking the risk that private lenders would deal with. So credit unions are a really good partner to deal with if you're kind of in that lower mid-market space. But if you're a national company, you're going to grow beyond the resources of a credit union, and you need to upgrade to a bank. Even though obviously, when you're a small business, if a credit union is backing you, they're actually probably going to be a lot more flexible, lenient in terms of if you have a hiccup, and they're just simpler to deal with. And then on the top left side, you have specialized lenders. And so specialized lenders are typically industry specific. You have auto lenders, plane aviation, equipment financing companies, mining equipment financing companies. So super ultra specific products that are designed for that end user. And the advantage of that is that, a bank is a financial supermarket. They're going to deal with very general products. They'll give you an operating line and a term loan, but they'll try to group and think about, their potential clients as, very similar, even though truly businesses are very different between industries. Whereas an industry specific lender is going to be more hyper focused on your type of business. And so the products that they can offer you are probably a little bit more competitive, a little bit more flexible, but their cost may be a little bit higher. But that obviously comes in terms of dealing with very specific industries and higher levels of risk. So if I were to look at the Canadian marketplace that I deal with, you have the big Canadian banks at the bottom left over here. You have the credit unions on the right, the Meridians, the Pace credit unions. And so, again, they're competing with similar clients as the big banks, but again, they're probably more community focused and, don't have broader products than the banks, but they have more dedicated patients to deal with local community businesses. Whereas on the top left, you have the specialized lenders, tier B lenders like BDC, CWB, Roynet Capital, or there are specialized lenders like GE Capital in the aviation sector or mining sector. So, these businesses, again, like these lenders, they're going to be higher priced than the bank, but they'll deal with more risk appetite, and they'll typically be a lot more flexible in dealing with your type of business if you obviously meet the programs that they're looking to target. And then at the top right, you have the private lenders, the Fiera Capitals of the world and the Cortland Credits. And, these lenders are obviously going to give you very, covenant light, interest only type solutions, which are flexible, but obviously the price is going to be, very significant relative to, cheaper alternatives out there like the banks or the credit unions. So just to kind of drill down into the specifics, and you can pause the slide here just to read these. But as I mentioned, industry specific, competitive rates. They'll focus on smaller deals. If you wanted to get a $200 million facility, a specialized lender is not going to carry that level of exposure. The banks are going to be your only solution at that point in time. And that's the irony. Even though you're a big business, the bigger you get, ultimately only the banks can be your service provider because they're the only ones that are capable of handling the size of your loan, right? So a lot of private lenders and specialized lenders, size limitations are a factor to consider. And then the last one is fees. So when you're thinking about borrowing, there's the upfront commitment fee, which is a one-time payment that it just ultimately is pure margin for the business, for the bank. And then there's the interest rate on that loan, which is an ongoing basis paid monthly. So there's big differences, right? And I've kind of in this last slide I alluded to the interest rates in terms of where the rates are. But in addition to these interest rates, there are upfront fees. And typically, the banks and the credit unions and the specialized lenders are usually going to be all within a relatively low range for upfront fees. While their rates differ, you can see 3 to 6, 4 to 6, or 3 to 5. While their rates differ, their upfront fees are going to be the same. It will be probably 0.5% or maybe 0.75% of the loan value, which is paid upfront on the deal closing. Whereas with private lenders, because they're very profit-seeking and profit-oriented, and usually private lenders are private investors that are ultra-focused on rates of return, upfront fees are actually a variable, valuable way to drive your rate of return as a lender because they're pure margin. You're collecting that fee upfront the day of closing to fund the deal. So private lenders typically ask for 2, 3, 4% of the loan value upfront, in addition to the 7+% on an ongoing basis. So you can see the cost of dealing with private lenders, even though the advantages are there, right? There's no covenants, very quick. They can fund. They're going to deal with very high risk businesses or businesses that no other lenders will touch. That's a good thing, but you're going to pay the price in terms of high upfront fees and higher interest rates. Whereas, looking down here, and this is everything that I've already repeated, the most competitive rates and really in terms of just the standard product, if you're looking for an operating line, going with the banks is going to be the best solution for you. Even though there may be more flexible products, the all-in cost of paying for that flexibility relative to what you really need an operating line for, it's just better to work with the bigger banks because they're going to be the cheapest solution for you. So let's delve into the lending process. And I just want to preface this by saying all 4 of these lenders, the funny part is their process is the same in terms of analysis, stages of discussion, and everything. The key difference is timing. Private lenders are super fast. Banks are going to be super slow. And these guys are going to be in between. So, this whole process, the steps I'm going to, explain right now are the only difference between all four of these buckets is the timing on the process. So let's look at the first phase. Okay, so this is the pre-deal when I'm initially meeting the prospect. I'm doing the initial due diligence, determining if this is a deal that I want to take on. I give the prospect the term sheet, and then I begin the credit underwrite to really internally go through the process of actually getting this loan approved. Okay, so that's the first phase, and this is super important. A lot of borrowers misunderstand the position of the person that you're dealing with. I've dealt with this countless times when I was at the bank. A lot of customers will say, "Well, can you just approve it? Like, can you get this loan done? Can we approve it?" And I have to always explain to them that I don't approve these deals. I get the lead, I underwrite the deal, I work with you to kind of put together that package, that credit underwrite, but I'm actually essentially the outside sales to the bank's inside sales team, which is the risk adjudicator. So you have to understand the positioning of that relationship manager, account manager, or banker that you're dealing with as the borrower. You're dealing with the representative that's trying to bring in business and organize, but he or she is not the enemy. And I've always positioned myself to be very honest in that process up front when I dealt with business owners on the lending side. I'd always explain to them, listen, I'm your internal representative. Don't try to hold information back from me, because the risk team is going to ask those tough questions. And if we're not prepared, we're not going to get this deal done together. So you want to make sure that your relationship manager is informed about your business and is willing to fight for you internally with that risk adjudicator. But there's a clear wall between the two. That risk manager is not going to, in most instances, is not going to be able to approve your loan, okay? Because the banks are going to separate that responsibility between two teams. So my recommendation in the upfront lending process is that you want to make sure that you're building a good relationship with your risk manager, you're informing them properly, and you're giving them the support they need to fight for you internally with the risk team. And this process, as I kind of explained it, is going to take anywhere from 2 to 4 weeks, sometimes even 6 weeks, depending on how long it will take for you to gather the information for the credit underwrite, because that credit underwrite is going to have a ton of information that you need to submit. Okay, so let's kind of delve into the first phase. So the first phase is that pre-deal initial introductory phase. So your first meeting, you're going to meet with that banker, and really the first things that the banker is going to look for is they want to sign a confidentiality agreement. Most lenders are going to have a document for you to sign. Obviously, you're going to be sharing personal information, your personal net worth and your financials and all that. You want to make sure that there's a confidentiality agreement, especially with private lenders. Like, that's one where some private lenders won't ask for confidentiality agreements. They're a little sloppy, but you're sharing your personal information. You need to make sure that you're at least protected in that. And then the very first thing that I always ask for is a minimum of 3 years of financials. And banks, and most banks, will require you to have review engagement prepared financial statements. So not audit, but not notice to reader, right in between, where the accountant has prepared and reviewed your financials to a certain degree. Because notice to reader and internal QuickBook outputs of your P&L statement are not accurate enough and not correct enough. There hasn't been a third party check by a CPA accountant, so the lender's going to really discredit the historical financials. And funny enough, this is a key problem for some businesses that cheaped out on not preparing their financials on a review engagement basis. They only have notice to readers, and so before they can even get funding from the banks, they need to go back to their accountant and upgrade their historical financials from NTR to review. So just make sure that banks are going to look for review engagement financials. Alternatively, private lenders, they don't care as much, but if you're dealing with the big banks, they will care about your review engagement. Also, I'll ask for a personal net worth statement. Just to understand, are you, heavily in debt? Are you fully levered and, have tons of gambling debt? Or are you, well capitalized on your personal balance sheet and you have money to support this business? Especially if we put money into the business on the loan side, there's a hiccup and we're going to ask you to put more money into the business to protect our asset, right? We want to understand how wealthy you are and what your financial capability is. Then give us a background. What do you do? What is your business? When did you found it? Give us your personal history, and then give us a summary of the ask. What are you looking for? Are you looking to borrow money to buy a piece of property, to buy another business competitor, whatever the case is? Give us the ask and be detailed. Sometimes I have to ask multiple times and saying, okay, can you kind of explain why you're doing this, or okay, can you explain that in more detail? So just be detailed and help that banker understand. As I said, they're your internal advocate, so you want them to be well informed and just as passionate about your business as you are, right? So just give them that information that they need. Also ask for an organizational chart just to understand, do you own the business entirely, or do you have silent investors that I need to talk to you about? Can you kind of explain your position? Do you hold your business via a trust? Do you have other holding companies that own other related assets? So I just want to understand holistically, where does your business fit on your organizational chart? And then from your perspective, you want to make sure in that first meeting that you talk to your banker and get a sense of their experience in terms of lending to your type of business. Say, for example, you're a big trucking company and the person that you're talking to specifically has never lent to a trucking company. Well, it's going to take a lot more time to educate that banker on what trucking companies do and the marketplace and all that kind of stuff, which will slow down your process. So if it's a time-sensitive deal, make sure that you're dealing with a banker that understands your business, has lent to probably competitors of yours in the local marketplace, and can quickly underwrite your deal in a much quicker way. Now, obviously, if time is not as sensitive and you have time to really go through the process, this is less relevant. Now, once you've given all that information, that banker is going to sit down and review everything and get back to you with an initial set of questions. So ask about your financial performance, your organizational chart, your personal net worth statement, whatever the case is, whatever you gave them up front, just so that they can continue to learn about the opportunity and understand what specifically you need. Because a lot of the times business owners know, well, I need $1 million. Okay, but what type of structure of that $1 million loan do you want it to be in? Do you want a very deferred loan with interest-only payments? Do you want a quickly amortizing loan? How do you want to securitize it? Do you want to just borrow it personally, or do you want to securitize it against the business? So there are other considerations, and that will come via that first discussion. Now, in that second meeting and onward, there are going to be those follow-up questions to better understand the ask. And, you want to discuss at a high level what the lender is willing to provide. So, give them the time, give them that information, maybe have a second meeting. But by the third meeting, you as a borrower should be asking the lender, okay, you've seen my information. What do you think? Like, what's really doable here? Like, what do you think the bank is willing to deal with? And most lenders are going to be honest in saying, yeah, I don't really think we can get 1.5 million. Like, I can stretch, we can see if it's going to work, but it's not going to be doable. I think, at most you can borrow $1 million, whatever the case is. So get that honest feedback to understand what is expected in terms of the loan value amount, the pricing, the amortization, the upfront commitment fees that we've talked about, and other expected financial covenants that come with that loan. And ultimately, if you're comfortable with whether the banker is guiding, you can say, you know what, yes, I'd like to see a term sheet. And so a term sheet is a non-binding document that summarizes the lender's stated terms. And so at this point in the process, you can try to push back, maybe reduce some fees, and I have a separate video on that talking about how you can negotiate term sheets and what to negotiate. You can try to negotiate some of the commitment fees, see if you can change the rate structure, maybe put in some kind of step downs as you pay down the loan, and also negotiate the timing of the fees. A lot of lenders are going to ask for you to pay that commitment fee at the time of the term sheet. I always recommend that my clients sign back the term sheet and say, no, I'll sign back the term sheet, commit exclusively to working with you, but I pay the lender fee, the commitment fee, once the deal is approved and funded. So you pay that fee net of the funding that you receive in terms of the loan. So you don't have to put money out of pocket and sit 6 weeks to wait for approval and funding, and you're out $25K or whatever the case is. And so just to explain, that term sheet again is non-binding. So, a lot of those terms, while they're good to discuss up front, always know in the back of your mind, this may go wrong. The risk team and the banker may not agree on in terms of the outlook for your business, and they may push back and change certain terms. So it's not set in stone at the term sheet stage, but it's a rough estimate. And most good bankers know their risk team already. They've been dealing with them for years. They kind of understand how they're going to think about your deal, and so they'll probably give you some relatively accurate terms of where the offer finance will come in at. Okay, so now let's kind of talk about what lenders are looking for. So, I've received, I'm going back to these meetings over here. So I've received all those review engagement statements and I'm thinking about preparing a term sheet for you. What am I looking at specifically? What, as me as a lender, am I analyzing and looking at? Well, the first thing is the existing loans. You want to make sure that from a lender's point of view, I may not be the only lender to this business. There may be other loans and a mortgage, some, whatever short-term, interim loans. So I want to see a full summary of all outstanding loans and the terms on those loans. What's the outstanding balance? What are the monthly obligations in terms of principal and interest? And I want to understand how that factors into the money that we're considering lending to you. Right? So you want to have this prepared. You want to, especially if you're going to a lender and you have other loans on the books, you want to have that information ready because they're going to ask for that information because that is relevant to them. They're going to, and this feeds into the second point, they're going to build a financial model which calculates the cash flow available for debt servicing minus the existing loan obligations plus the loan that they're going to consider putting on the books coming from them. So they want to understand what's coming in and what's expected to flow out from a debt perspective. So you want to give them both of that information. You're going to give them financial statements so they can calculate your cash flow, and then you're going to give them any existing loan information so they can understand what obligations the business has today. Now, that feeds, as I was just discussing, so once you give them the financial statements, you also want to clarify if there are any personal or discretionary or one-time expenses on the books that can be normalized, that can be added back to boost your cash flow for their analysis. So there may be certain situations where you took an inventory write-down or collected, one of your big customers, went bankrupt, but you quickly found another business and blah, 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 or you had one bad debt, but then collected it in the next year. So you want to clarify and identify expenses that can be normalized to boost your cash flow for their internal financial model. Okay. So once I calculate my adjusted cash flow that's used for what I expect to be available for the loan servicing, I'll then work backwards and think, okay, well, based on the $400,000 left available for us, I think I can maybe lend another, $1.2 or $1.3 million on that. So most lenders, my rule of thumb when I would think about structuring deals is that I would look at 2 to 3 times the cash flow available for debt servicing. So if you have $500,000 available for debt servicing, at most I give them 1 to 1.5 million just as a base. And then I'll try to push higher and see how the financial model changes. So there is a bit of an iterative process, but that's how I would think of it from a lender's point of view. And then ultimately, that financial model, a lot of lenders underwrite on historical cash flow, but they also take in consideration that, listen, we expect these cash flows to continue. So what does the high level outlook look like? So you want to make sure from your perspective, you educate the banker. We got a lot of growth. These customers are sticking around. They've kind of guided that they're going to buy at similar levels next year, blah, 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 blah. So you want to communicate to the banker that not only are you generating these profits today, but they'll continue in the future, and give them proper support or give them a good analysis of your outlook. So be detailed again in your discussions with your banker. And then the last thing, I always care about skin in the game as the lender. When I would look at a prospective deal, if the buyer was putting no skin in the game, no equity in the deal, it was aggressive, and I understand why they don't want to put money in the deal. But from my point of view, you got no skin in the game. Outside of just guaranteeing the loan, how am I going to protect my investment in you as the lender? So a lot of lenders will typically look for a certain level of equity in a deal structure to make sure that there's skin in the game, that you've put real cash into the deal that is at risk of being lost unless you fight for this business that I obviously am lending to. Right? So on a lot of real estate transactions, that's why those down payments are really important. So for commercial real estate property acquisitions, a lot of the big banks, especially in Canada, are going to look for 25 or 30% of the equity check as a down payment for skin in the game. For management and M&A transactions, 20 to 40% is usually what we see. Whereas for equipment, equipment typically is a smaller purchase price. And for a lot of the banks, if there's not a lot of leverage on the books today, they'll fund up to 100% of the equipment value. But sometimes, some lenders will ask for a little bit of money as a deposit on that equipment so that you at least have some skin in the game on that deal as well. But these are the 4 things that I look for when I'm pre-qualifying that term sheet. What's obligations that need to be paid? What are you generating today net of those obligations? How much can I really lend using that cash flow? I just want to make sure that the business is going to do well or is going to continue to grow. And ultimately, are you committed to this deal? Like, what are you putting into this deal so that I can communicate to my risk team that you're just as committed as we are to making this deal a success? So, what are some factors that affect the borrower's capacity to borrow money, right? So one of the things that I look at when I'm looking at, this information. So I've built the financial model, I've had discussions with the owner, but through that conversation, things may come up that will negatively impact the borrower capacity. So I always get this question from prospective clients now when I help them in raising loans, is that it's like, well, how do the banks think about X or Y or Z? So I'll talk about some very common negative red flags that lenders look out for that will most typically limit the amount of money that you can borrow. The first and very common one that we always see is customer, sometimes supplier concentration, but most cases customer. Your top customer accounts for 40% of your business. Well, if they leave, how are you going to replace that 40% within a year to sustain the level of cash flows that we underwrote the loan at, right? So if you have a lot of customer concentration, we're going to be less aggressive in lending and giving you more money on your cash flow, because from a lender's point of view, our worry is if that customer leaves, we're screwed. You can't repay the loan. Another thing is supplier terms. If you're working in a business, say for example, the defense sector or in the contracting business, where you're selling things, your services or products, but collecting on those sales is going to take 90 plus days, 120 plus days. Well, then all of a sudden, the actual cash flow, real cash flow that's generated off those sales is super delayed. So, it's a negative in terms of looking at the business and saying, can you actually generate the cash flow you need today to really support the interest payments on a monthly basis? And some businesses, unfortunately, especially if they're project oriented and they generate 60% of their revenues in a single month, and they have net 90-day term payables, well, then all of a sudden you've delivered these services, but the cash flow is only going to come 4 months after you deliver the services. So there's a huge gap in the cash flow of the business. So that's another negative that we usually see. Another one is environmental concerns, the quality of the property, or there's potential lawsuits related to environmental. So the value of the underlying asset that we're lending against, like a property, would be undermined by these environmental concerns. So lenders will almost black flag the deal if it's environmental related, but maybe the business is a chemicals business and there's always environmental risk. Lenders in general will limit their amount of exposure to chemical related businesses, again thinking about the potential environmental risks. And another one is, where is the business primarily generating cash related payments? So, lenders like to see businesses that have clear reportable revenues and reduce the amount of potential fraud in the business or, underreported income. So businesses like nail salons, hair salons, car washes, where there's a lot of cash transactions, lenders and lenders, they have the pick of the litter. We don't want to deal with businesses like this simply because, there may be potential fraud or you may be hiding funds from the bank, and it's just, it's too much of a hassle. So a lot of these businesses don't have the same level of access or appetite from a lot of the traditional lenders. High-risk sectors are another limiter. So cannabis related up here in Canada where it's legal, a lot of business banks, a lot of the traditional banks still don't like cannabis, so they stay away from it. Or it's traded with high-risk regions. I was looking at a prospect where they were buying steel from Pakistan. And so, there's a ton of international risk and suppliers that were potentially criminal organizations. And so the bank ultimately said, well, we don't want to deal with businesses that have suppliers in high risk regions. So we're going to stay away from those businesses. So that's another potential black flag. Now, sustained declines in financial metrics. So if there are underperformance, declining revenues, declining gross margins, net working capital, or your prices in general, it's a very highly competitive sector. The bank, via their research, are going to really zero in and say, hold on a second, you may not be able to sustain the historical cash flows that we're underwriting on, so we're going to stay away from this business. Lumpy project-oriented revenue. So we kind of talked about this in this extended supplier and customer terms point. But if you're a contractor and you have a lot of holdbacks, or you generate 90% of your revenues in month 11, I'll give you a good example. I was looking at a tax services firm. And naturally, tax services are required during tax season. So during the summer and spring months, there was a lot of interest in their services, but fall season, it was completely dead and they wouldn't generate any revenues. So a lot of their revenues were back ended in the later period of the year. And obviously, loan needs to be repaid steadily on a monthly basis. So how would they generate the cash flow needed to service the loan during the slow months, right? So the bank obviously limited the amount that they were willing to lend to that type of business. Foreign exchange gains is another really high risk area. So especially for Canadian businesses, Canadian businesses sell a lot into the US, but if you carry a lot of foreign exchange risk, well, obviously if the Canadian dollar relative to the US dollar change, then your whole profitability, pricing, and competitiveness in the market changes as well, right? And say, for example, worst case, it equalizes to 1-to-1 kind of FX ratio, then a lot of businesses' profitability are going to get eroded, and that will ultimately put at risk that potential borrower. And then, as I kind of mentioned already, the lack of skin in the game. If you don't put money in, then it just communicates a lack of commitment from the lender's point of view. And then a high level of capital expenditures. So if you're a business that requires $500,000 a year in fleet maintenance and buying new equipment just to sustain the current volume of sales, then what I usually do is I'll take your required level of working capital and deduct it from your cash flow available for debt financing. And then that is the net amount that I actually use. So sometimes lenders will actually take your annual historical average capital expenditure and net that against the adjusted cash flow of the business, and then underwrite the loan based on that net amount, which obviously accounts for these capital expenditures. But say, for example, if you're generating $1 million in profit, but in the last few years somehow you've been spending $2 million to replace equipment, then really the net cash flow for that lender is negative and they'll probably stay away from you. So these are a lot of the kind of common things that I've come across over the years. And, these are things that you need to address or at least be aware of in terms of your expectations. And in a lot of instances, the banks are not going to want to listen to, oh, I have an answer to this in the future. They're going to want to see it right now. And if you have that exposure today, then they're going to underwrite with that, considering that exposure. It's very difficult to negotiate away these black flags. It's very difficult to. So, speaking of these black flags, if your proposed loan presents certain challenges to credit approval, and it could be high leverage, poor historical debt servicing, industry risk, to save some time when you're dealing in that initial phase, pre-term sheet phase, it may be better to, before a term sheet, submit a preliminary deal review sheet to the risk team. So you can ask the risk manager to say, listen, let's go to your risk team and do a prelim. Let's have a first look at the deal and see what their feedback is. And internally, most bankers, will do that informally, but there are formal processes that are called preliminary deal reviews or drive-bys, whereby, that banker is going to prepare a 2-page summary sheet and it will officially get submitted to risk. And the risk team, it's essentially a underwrite light version, where, at a high level, the risk team is going to provide their guidance and perspective on these issues. And then you can use that to decide whether you want to continue down that process and that path and move forward with this bank, or change banks and find another lender with a different take. So preliminary deal reviews are a great way to save some time and avoid, obviously, the 4 to 6 weeks that you would commit to getting that deal underwritten and approved by the risk team, or potentially declined, and you've just wasted 6 weeks dealing with a lender that you could have found out via this deal prelim. So as I kind of mentioned, this 2-page summary is going to have your kind of high-level customer information, competition, some description on your management team, some key employee commentary, and obviously an analysis of your historical financial performance and why you're underperforming or why you're growing. And you're still going to have to provide a lot of the same information that a credit underwrite is going to require in terms of customer, supplier, and product documentation and historical top 10 analysis of your top 10 customers, your top 20 customers. And then as well, it will require the supporting documentation for your deal. If you're buying a property, they're going to ask for the purchase and sale agreement of that property. Or if you're buying a piece of equipment, they're going to want to see the brochure on the equipment, the invoice that's expected in terms of purchase price, and et cetera, et cetera. So all the information that you're going to need to submit for a credit underwrite, you're going to submit for the deal prelim, but it's just a short-circuited way to get commentary from risk quicker than going through the entire credit underwriting phase. But once the relationship manager commits to underwriting the deal, they will move from the initial upfront due diligence phase into a more detailed analysis of the business and the historical performance of the business and the fundamentals. So I just want to kind of clarify this. Underwrites for a lot of real estate transactions are fairly simple. So depending again on the type of loan, the level of underwrite is going to differ. So if it's a real estate deal, there's no really underlying operating business. It's going to be a lot quicker, right? They're going to get the rent roll of the property. They're going to look at the net operating income. They're going to do a quick analysis of building condition report to confirm any types of repairs and maintenance that are required for the property. But that's it. There's not really a lot of operational or competitor analysis. Versus if a lender is doing a cash flow loan where they're unsecured and they're lending against the enterprise value of the business, well, then they're going to care about the value of that business and the outlook of that business. So the level of scrutiny is going to change and is going to increase. So, a lot of the documentation on these key areas here are much more relevant for unsecured, business related, management related buyout loans. For a real estate loan, it's going to be a lot more simple and a lot less detailed in terms of the credit underwrite. So what are some of the key areas of that credit underwrite? Well, first, a lot of lenders are going to start off their underwrite by actually going out and seeing you. They're going to tour the facility. They're going to tour your business. They're going to sit down with you face to face and actually get a feel for you as a person. And they'll visually see your business at work. And it's a great way for you to quickly educate them and get them in person to sell yourself and your brand. So I look at that site visit from the lender side as a great way to learn about the entrepreneur and their personality and their personal values. From your perspective as the borrower, you also want to communicate that and you want to sell them on your vision. So it's a really good sales meeting for you to take advantage of as well. And ultimately, from that site visit post, that relationship manager and banker is going to ask for, a summary of your products, your major products and services and the opportunities and the outlook. They're going to want to see an environmental review of the company's real estate and operational policies. They're going to want further information on your shareholders. If you have minority shareholders, they're going to want your corporation documents. They're going to want to see all your permits and contracts and licenses required to operate the business. They're going to want to take a deep dive into the financial side of the business. Give me your top 10 customers and suppliers for the last 3 years. Give me a breakdown of the sales based on the product and location. Give me a customer order backlog. Help me understand your top biggest orders right now. Why are they buying from you? Are you where's your pricing methodology? Are you a high cost price solution? Are you a bottom feeder? Are you in the middle? How do you compare against other competitors? Talk about some of the customers that you've gained in the last few years. Why did they choose you versus others? Why did you lose some of your key customers if you did? And walk me through your credit terms. What's your credit methodology in terms of invoicing customers? Do customers have a certain level of history that's required before you give them credit, or do you give everyone credit? And then give us a detailed overview of your fixed assets, a breakdown of your capital expenditures, a breakdown of your AR and AP aging schedules for the last 6 months. Give me a bad debt analysis so I can understand what bad debts have happened in the past and why it's happened. So there's a ton. I'm kind of just literally listing them off here. Industry analysis, employee-related information, summaries of operations and manufacturing processes, and ultimately your IT. Nowadays, IT is important. Cybersecurity procedures, how are you protecting yourself? So all of these things are required. And the larger the loan, the more complex the loan, especially if you're a mid-market businesses, there's going to be a lot more information like this. Whereas if you're just borrowing for an operating line, they're going to spend a lot more time just on the high level, what you do and what your products are and what are your customers, and less on the industry and pricing methodology and customer churn and all that kind of stuff. But it all depends on the type of lender and the level of information that they want to get comfortable with you. So I would say be ready for this information, but sometimes, there are certain situations where, you may not see this request, especially if your deal is a lot more traditional or less risky. Now, the credit underwriting process can feel like a black box because you don't know if the bank is going to approve your deal as you keep giving them this information. So it takes typically 2 to 4 weeks for the underwriter to aggregate this information, go back and forth, put together this detailed document, and then submit it to risk. So, throughout that process, you're going to keep, giving them information, ask them, hey, have you heard from risk? Have you heard from risk? So you just need to be patient and understand that for the first 2 to 4 weeks, that underwriter may be only putting together your document and may not have submitted it to risk at all. So you need to wait until they submit it to risk before you ask those questions. So from your point of view, I always recommend, from a borrower's point of view, that you want to delegate some of these responsibilities. So if you have anything financial related in terms of generating the top 10 customer list and the financials, and I have some questions about your accounts receivable policy and all that, get your controller to deal with the banker so that you don't have to answer those commonplace questions. If it's anything operational or client facing, connect them with a sales manager, an operations manager. So try to delegate down and get multiple people to deal with the banker so that at least in terms of when you're educating the banker, you're not spending all this time since you're repeating to them what you already know. Get your employees to do that for you. But obviously when it comes to the big stuff, the critical stuff around potential borrowing and term loans and the structure and all that, you need to deal with that. You don't want to delegate that to a CFO. Now, always provide more detail than you think is required. So I always, when I was a banker, I think I signed off dozens of emails saying, please be as detailed as possible. So I always ask clients to be as detailed as possible. When you say, oh, revenues are declining, don't just state the obvious. I can see revenues are declining. Why are they declining? What were the primary drivers behind that? So be as detailed as possible to avoid the back and forth questions and give bankers a complete overview and understanding of the company so they don't have to go back and ask you more questions. So these are just good practices in terms of reducing time at the credit underwriting phase. Now, after the credit application is completed and the relationship manager has submitted the application to their risk team, it takes about a week or 5 business days before they'll hear back from the risk manager. The risk manager has, they're inundated with a bunch of these applications from across the bank. So they're not going to pick it up day one. A lot of bankers are going to say, oh, we can turn it around in 24 hours or 48 hours. They're lying to you. I have never seen a bank do that. I've never seen a one-day turnaround on a bank because banks are just notoriously bureaucratic and busy. And so a lot of the time, it typically takes up to 5 business days for the bank to review that credit application. So, make sure that you're patient and make sure that, you understand kind of the timing around that. Now, some risk groups will ask for further information or clarifying questions. And in most cases, the relationship manager is educated enough, especially if you were detailed on your business, to answer those questions quickly. So you won't really hear a lot from the risk team about, specific questions. But ultimately, if the risk team wants to change your deal, then yes, that relationship manager will come back to you and will be that intermediary. It's very rare that a risk manager will get on the phone and deal directly with the end customer. They kind of hide behind the relationship manager. So the relationship manager is kind of that in between, relaying what the risk team is saying to you. Now, if the risk department declines the deal, there are 2 things that you can do. You can collect your refundable commitment fee and ask a commercial banker for a referral to another lender that would consider doing the deal. They're going to be actually, funny enough, the best referral source for you. You spend all this time, they know your business really well now. So, and especially if they're experienced enough and have been around in the sector, they probably have buddies at other lenders that may look at your deal and think of it more in a favorable way. So ask the relationship manager for a referral to another lender. Now, the other is you can renegotiate. You can try to renegotiate the term sheet to a more doable deal, reduce the loan amount, increase the equity invested in the deal, increase the interest rate to obviously compensate the lender for the higher risk, or give up more security, pledge your some personal assets or pledge another property that you have in another holding company to make the lender feel more comfortable. In most instances, the reason why a lender will decline a deal, especially if you've gone through and you already did the deal prelim and the term sheet and all that, is that either your business has started to underperform, so the underlying cash flow has started to change, or there's a very specific reason. They did some research on your industry and they were not comfortable with the outlook. So it's usually outlook related. They're betting on you to perform. And in most instances, some lenders will find some reason. So you want to drill down, and sometimes don't just take the no, ask why did you say no? And let me see if I can explain to you or re-educate you on that issue. And sometimes it works, right? And in most instances, what ends up happening is it's a combination of both. More education, more communication with with the relationship manager who passes it on to the risk team, in addition to changes in the term sheet, reduction in the loan amount, and probably a little bit of an increase in the interest rate to give more profit to the lender. Now, if the risk department approves the deal, the relationship manager will take that under, right? Some, obviously internally submit it and register the terms that were agreed to by the risk team, and then the internal bank will draft a legally binding document called an offer of finance that summarizes the terms of the loan that were approved by the risk team, and that's given back to you. So this whole process, you've given them tons of information, you've waited 4 to 6 weeks, plus the turnaround time required for the risk team, and if they approve, that's when you're going to receive back a document confirming to you, we've signed off on the deal. Here are the terms that we're willing to offer you. If you sign this deal and you pay the commitment fee, we can fund the transaction. Okay? Now, once the credit application has been approved by risk, ask the relationship manager, does the bank prepare the offer of finance, or do you have an external legal firm to prepare the document? So the reason why I put this here is that in certain instances, the bank will internally prepare this binding legal document because they have a standardized form, and therefore it's going to be quicker. In an instance where the bank doesn't prepare the offer of finance and they have a legal firm prepare it, just understand that the bank is going to ask you to cover their cost for the lender. So you obviously have a vested interest in making sure that they get the document done in the shortest amount of time possible. Or as well, the bank is gonna say, hey, listen, we deal with this one legal firm. I always recommend to borrowers, you ask, okay, who's the legal firm that you commonly deal with? Can I get some quotes from your second alternative lawyer? So get a second quote, because the bank is usually going to use one lawyer that they prefer to work with. But by getting a second quote, you can compare the cost. And then sometimes, there's such a big cost difference that you can justify lowering the cost on the preferred lender. Most banks don't want to change preferred lenders. They'll ultimately still go with the number one guy that they pushed on you. But in certain situations, by at least getting that second quote, you have some pricing power to push back and reduce the fee. And so it's really important, once the offer of finance is done, understand the process. Is the firm preparing the offer of finance, or does the bank have an internal team, which will save me cost as well, because the bank doesn't have to retain a legal advisor for this portion of the process. So once you do that, you can understand how much it's going to cost you, and then you can ask the bank, can your preferred legal partner provide a quote, and can you get a secondary alternative as a legal quote so that we compare the two? And now, once you have that, you will have a really good understanding of the cost that you will have to pay for as well. So in addition to the commitment fee for the deal, you're also going to have to pay for the bank's legal costs, which I guess, funny enough, some people are still surprised by. And it's a pretty good deal for the banks, funny enough. Now, the closing process is as follows. Once the offer of finance is sent to your legal counsel, there'll be revisions back and forth in terms of clarifying certain documents. But a lot of it has already been agreed to, or there's not a lot of dispute. Like, I don't really find that offers of finances are disputed. It's just a lot of questions in terms of their counsel, the borrower's counsel, and you as the borrower understanding the terms that we've put in front of you. Now, you and your lawyer will then begin to work on delivering the conditions of funding. Now, conditions of funding, there are several. A bank's going to want to make sure that they securitize against your assets. There's certain payouts against certain previous loans, whatever the case is. So, when you see that offer of finance, a common section is going to be conditions precedent to funding, or conditions of funding. Start working on those conditions and knocking them off in the weeks up to the funding so that you can move the process along quicker. Now, the bank's counsel will do a PPSA search for registered liens against the business. And, in most instances, you may have a lien for, a good example is a car lease. You use vehicles in your business. And so, Mercedes Canada has a car lease, and there's a registered charge against the business. Now, because most lenders and most senior lenders want to get a subordination agreement, which clarifies what charge and what level of seniority each lender has on the business's value. And so most senior lenders want a senior charge on the business, and they want to subordinate all these other registered liens. So this PPSA search is done up front to identify any registered liens against the business, and then it will take you as the borrower a few weeks to reach out to those existing lenders and say, hey, by the way, I'm borrowing some money from TD Bank, and they're going to need you to sign the subordination agreement, see attached. And then they'll have to go through their process of agreeing to that and signing that subordination agreement. So this is very commonly the longest period of time spent in the closing process. It delays a ton of deals usually because the common issue is you reach out to a past lender that has a lien on the business and they don't answer. Or, your point of contact has changed, or, they just, their internal process takes a very long time for approvals and blah, blah, blah. So, getting the PPSA search done and cleaning up the liens on the business and the subordination charges that need to be agreed to, get that started early on. Once the deal is approved, then you can move into legals. And once all the documents are finalized, the bank's risk team will do one more pass through. They'll confirm all the terms have been met. You've met all the conditions of funding. Our liens are properly secured, and we have the correct subordination agreements. And then they will agree to release the funds. And typically, the flow of funds works this way: the bank has the funds on their balance sheet. There's an internal sign-off. It's released to the bank's lawyer's account, an escrow account. It's then moved to your lawyer's escrow account, and then it's moved from your lawyer's escrow account to your balance sheet. So it essentially passes through three people. And the funny part is both the bank's lawyer and your lawyer are going to charge disbursement fees. So it's a bit of a toll, whereas the money moves along down the chain, it will get funded to you. But banks very rarely will fund direct from their balance sheet to your balance sheet, simply because they want to have that buffer of liability protection where the bank sends it to their legal counsel, and then their legal counsel sends it to another legal representative that is representing you. So just understand the flow of funds. I only saw one deal where it went from our counsel direct to the borrower. In most instances, it will pass from our counsel to the borrower's counsel. And that way, if they end up misplacing the funds or stealing or whatever the case is, we can point to your lawyer from the borrower's side and say, well, you hired the incorrect lawyer. So that's the reason why that happens. Now, what are the estimated costs? I talked about those, quotes that you needed to get for the bank's legal team for the legal process. And it ultimately typically depends on the size of the loan. For really small business loans, plain vanilla real estate transaction is going to be $7,500 to $10,000 all in. And that factors in the disbursement fees, the legal fees, the preparation of the offer of finance and everything. But this is obviously in addition to the commitment fee on the term sheet that you still have to pay. Now, on larger transactions, then it will increase to typically $15,000 to $25,000. And again, these are rates that I'm seeing in the Canadian marketplace. They may differ in your local marketplace, but this is what I'm seeing in Canada right now. And so the cost increases relative to the complexity of the loan and the number of parties involved. So if it's a simple equipment loan, registering one charge on one piece of equipment, there's no subordination agreements, there's not a lot of legal complexity. It's going to be a very, very cheap transaction from a legal perspective. However, if it's a management buyout or an M&A transaction where you're dealing with multiple lawyers for multiple shareholders, it could cost another $5,000 to $10,000 on top of the $15,000 to $25,000 to get the legals closed. So I'll give you a recent example. We funded, so I was selling a $8 million business, and I'm just keeping in touch with the buyer, and the buyer informed me that on an $8 million deal, he had a $5 million term loan, an M&A term loan with multiple shareholders, and it cost him about $32,000 in legal fees for the bank's side of the transaction. So pretty sizable amount on top of the $5 million on top of their commitment fee, which I'm sure was another half a percent. So just understand that these are invisible costs that become fairly visible at the end of the process, but a lot of people don't think about them up front. And another thing is, This one is just more relevant for if you're in a rural marketplace and you're dealing with a JP Morgan. Make sure that you're dealing with the local JP office that deals with a local legal representative. One of the common mistakes that drives legal costs up for borrowing situations is that the lender tries to retain a high-priced attorney for their side of the transaction by dealing with attorneys at the head office level, right? People that are in the New York marketplace and the Toronto marketplace. There's a big difference in cost if you try to, get a Niagara Falls lawyer up in Buffalo than one in New York, right? So try to get the local legal representative that's pre-approved by the bank's vendor list to fund the transaction from the bank's perspective, and that will save you some cost. Now, once the loan gets funded, your relationship officially starts from a legal perspective with the bank. And so there are ongoing responsibilities that you need to maintain. Now, the first is, similar to requiring review engagement statements, a lot of banks and even private lenders want to see on an ongoing basis quality prepared financial statements. So if you weren't preparing statements moving forward, you're going to have to prepare review engagement statements for the term of that loan, which is usually, 5 to 7 years. For the next 5 to 7 years, you're going to need to incur that extra cost. As well, to keep track of that loan performance, lenders look at a benchmark that are usually financial covenants. That's their core benchmark to test the healthiness of that loan. If it's healthy or if the business is underperforming and may struggle to pay the loan back. So financial covenants track the ongoing performance of the loan. And so most lenders will try to calculate financial covenants on a quarterly and annual basis. So they'll track quarterly covenants and they will scrutinize it less. They'll get run it once using internal financials. But the annual review is important because with the annual reviews, usually the bank will also prepare a write-up summarizing the performance of the business and submit it to risk to say, as discussed in the credit application, when we put the business on, they've continued to do well. This is what they're doing. See proof of the things that they've committed to. So remember, if you're going to commit to something at the underwrite stage, you better follow through with it because the bank is going to continue to report on your ongoing performance as a client of the bank now. And so they're going to test your covenants in addition to write up a more qualitative write-up of your business's performance. So to save some time, what I personally recommend my clients would do is prepare a 1-2 page business executive summary of your year. What happened? What were some of your key wins? What were some of your key losses? What are you looking forward to in the future? And just kind of put together an executive summary that is A, helpful for you to put your thoughts down on paper, but B, just speeds up the Q&A portion. Once the bank is funded, a lot of entrepreneurs want the bank out of their hair. I got the money, I did the deal, I just want to focus on my business now. So, a really good time investment for you is to prepare that 1-page summary, flip it over to the banker with your financials, and they'll typically won't even reach out to you, especially if you're doing well. They'll just say, oh, okay, thank you, great to see you next year. Now, one of the challenges with a lot of these big banks is that, unfortunately, commercial bankers will change roles, right? They'll either leave the bank and go to another bank or, they'll get promoted to another division. So you'll actually see a ton of turnover if you haven't already. And, most commercial bankers, they have like an average useful life in their one role between 2 to 5 years. Within 5 years' time, I usually see a lot of these commercial banking teams just turn over completely and a new set of people are there. So it's really important to understand that if your direct representative in the bank has turned over and there's a new representative, take time, just as you did up front with the first guy, to educate the new banker on your file. Educate them on, what the opportunity is. Because again, they're your internal advocate. And on an ongoing basis, it's better to at least invest a little bit of time to communicate your story. And that kind of feeds into the last point here. The reality is that, bankers deal with a lot of clients. So, you don't want to be forgotten. You want to be considered just another file on their book that they have to manage. You want to be someone that they remember, beyond just the file that they have on hand. So I would recommend, if you're dealing with turnover a lot at your bank that you're dealing with post-funding, the best thing to do is take out the new commercial banker that you're dealing with now that's been assigned to your file for lunch. Meet them, give your history again, give a brief outlook of where the business is performing and just treat them kindly. And I'll tell you, when you need something, especially if you're dealing with someone new, that investment of time will help you in terms of seeing better service. That's why one of the common complaints, very, very common, is that a lot of business owners complain, oh, with all this turnover, I'm just getting terrible service. The reason why is naturally that new relationship manager doesn't know you beyond the file on hand, so they've never really gotten to feel comfortable with you, and they typically prioritize the clients that they bring on and they fund because obviously they know those people. So to avoid and at least improve your chances of getting better service, meet the new relationship manager and get to know them. And then lastly, encourage, and you should make sure that the relationship manager, most do, they'll ask for an annual site visit to come out and continue to see the operations, make sure that the operations continue to look good and healthy, and get to see you face to face. And so those site visits are where you should be taking those relationship managers post the site visit to lunch and just invest a little bit more time. So, at least once a year, if you can do that, it's worthwhile for them because they're going to do it for their annual review, and as well for you to continue to build your relationship. And so the last slide I want to talk about is loan brokers. Are they worth it, right? So funny enough, like my firm, Robley Capital, we're primarily an M&A firm, but some of our clients will retain us just to source term loans on behalf of them and act as an outsourced loan broker. So I'll take on engagements from time to time, but the reality is, you really want to make sure that you're picking a loan broker that has experience in the commercial banking world before. So my experience kind of bodes well for a lot of mid-market companies in the Canadian marketplace because I know what lenders are looking for. But, loan brokers are very effective solutions to generate a lot of term sheets. So if you're a business owner that's very cost sensitive, or you have a situation where maybe you have a unique transaction or high risk, and ultimately, you anticipate the bank to at least hem and haw a little bit, you want to make sure that you have alternatives. And that's what loan brokers provide. They speed up the underwrite process. They get you connected to the right groups to get the best level of service. And ultimately, they're going to generate multiple different looks in terms of the potential loan levels, the interest rates, the amortization, and the terms of the loan. So, getting multiple term sheets using a loan broker saves you a ton of time, and it allows you to better understand the marketplace. And they will also typically walk you through the lending process and provide additional guidance along the way. Maybe the lender is going to ask you for a lot of information. Some loan brokers will push back and say, well, you don't need that information. I know how your process works. Just cut to the chase. Here's what you're looking for, and we're going to provide this package for you. And sometimes, and what we typically do, because we work on larger transactions where we're seeking $20 million loans on behalf of a large manufacturing company, is we'll even prepare a prospectus, a 15-page document summarizing the financial performance of the business, the customers, and the history, and essentially pre-writing the credit underwrite for them. And what that does is it makes the underwriter feel more comfortable with you because you've already given them the information that they're looking for, and they can give you a more accurate take on whether the deal is going to get through and approve that what we're looking to get. So with a lot of loan brokers on larger transactions, they may even prepare these prospectuses summarizing your deal. So they can be worth it. On the other hand, if you have a very plain vanilla loan, there's not a lot of risk associated with the transaction. You don't really care about the marginal 50 basis point difference in the interest rate. It may not be worth it. So, and it all comes back down to cost. So really, how much do loan brokers cost? Most charge a small upfront retainer, $2,000 to $5,000, sometimes $10,000 to prepare that package. But ultimately, similar to a real estate agent, they get paid as a percentage of the loan value that is ultimately placed and funded, right? Because you don't want to pay a broker, $500,000 and the loan never goes through. You pay them once the loan is actually funded. And so most fee percentages on the funding amount, in addition to the retainer, are anywhere from 2 to 5% for sub $10 million deals. And for $10 million plus deals, it can be anywhere from about 1 to 2%. I usually see, I'll give you two examples, on a $20 million term loan raise, we did 1.75%, and on a $7 million term loan raise, we did 2%. So, huge difference in terms of rates, but obviously the potential fees change as obviously in relative terms to the loan size. And so who is best served by loan brokers? The first, and I'll put this one first, the first time borrowers or lien management teams where you've never dealt with a bank before, you don't really understand the required types of information and the steps along the way, where to negotiate, how to negotiate. Loan brokers can save you money, especially if you encourage them to push back and try to cut fees. So they would be a really good solution for first-time borrowers, in addition to borrowers that may not fit traditional lending metrics. A lot of banks, if it's a plain vanilla deal, as I said, you may not need a loan broker, but if you're a high growth company or you're underperforming and you're looking for a very flexible, non-traditional solution, well then there's a lot more negotiation, there's a lot more selling. Finding a broker to represent your interests may be a worthwhile investment to ultimately get a deal that can get funded. So those are kind of the common types of clients for loan brokers that we come across. Now, hopefully you found the video helpful. If there are any questions, I would recommend that you either comment below or reach out to me via LinkedIn or at my website at robleycapital.com. And as well, if you found the video helpful, then please like and subscribe to the channel for more videos. Hopefully, if you have any questions around connecting with Canadian lenders, I myself and my firm, we focus on the Canadian marketplace. So I would be a really good resource for you to reach out to. For US lenders, I have some connections down there as well, but happy to kind of use the forum and people in my LinkedIn network to connect you as well. So take care, everyone, and have a great day.